or sorry, Microsoft is down, Apple's up.
Yo, what up, everybody? How are we doing? We do have the one and only here, Mark Putrino, former hedge fund manager. We're going to be here with him today, going over some trade ideas, education, setups, and also, well, a whole bunch of stuff. Right now, I do think he's in the live class, but we're going to get him out of there because he's going to be here with us today. We're going to be going over some trade ideas as well from you guys in the chat. Make sure you leave that until the end. But I believe that Mark Putrino is going to be here. He does have the link. Let me just go ahead and make sure. All right, let me share the school here so that you can see more or less what's going on right now. Just having some issues here with the Zoom. It's kind of freezing up here. 1 second. Yeah, I'm not sure that I'm just having some issues there with the Zoom screen there. Not sure if, but I believe that Mark is getting in here right now. Let me go ahead and try to make sure he's good. Okay, I believe Mark is good. 1 second here, folks. All right, Mark is in the house. Let's go ahead and bring him on here. Sending him the link there. So I believe we're good to go. Without further ado, let's go ahead and bring on Mark Putrino, Chief Educator at the Benzinga Trading School, lead trader, mentor there, having a blast with the students. How was the class right now, Mark? I know you just got off that session.
Hey, Rodrigo.
What's up, man?
Not much. Getting a little bit of a.
So I believe we're good to go. Without further ado, let's go ahead and bring on Mark. Yeah, you need to. Yeah, so right now, right? Can you hear me there, Mark?
Yeah, just give me a minute. I'm having some audio sounds or audio issues here.
Cool. No worries. But folks, basically, we're going to be talking about trade ideas, education, setups. Mark Putrino, for those that don't know, has been trading in Wall Street for about 20 years. Former hedge fund manager, traded with Steve Cohen, Mario Gabelli. We're talking about multi-billionaires, 35 plus. These are, very well seasoned, experienced traders that are known around the world. Mark Putrino traded with them, everything from large cap pension funds to small caps as well. So looks like Mark has a little bit of a technical issue, but he's right back in here. So all good there, Mark?
Yeah, okay. I'm good. You can hear me good?
Yeah, I can hear you well.
All right, cool. Let's give me 1 second. All righty. All right. Yeah. So, yeah, thanks everybody. Yep. So Rodrigo, today is our investment psychology class, which is always a good one. A lot of people don't pay enough attention to investment psychology. And that's one of the reasons why people lose money. They make emotional decisions. They guess on things. They don't follow a logical plan, so to speak. And when you guess, you have mistakes. So the vast majority of the people that I talk to, when they lose money, it's for one of two reasons. It's because they guessed, or they just got some idea off someone in some chat room somewhere, or they had a plan, but they didn't stick to it. And those are both emotional decisions. So we really need to focus on emotional stuff, because you could have the greatest trading system in the world, but if you don't stick to it, it's not going to do you any good. And a lot of people perform well when they paper trade or when they are trying to develop a strategy or a system. But when they actually try to implement it into the real practical application of the market, they have a hard time sticking to it, because as human beings, we feel fear for things, right? We get afraid. It's just a
Right.
natural instinct that we've evolved. And there was probably a time where fear was a good thing, or situations where fear is a good thing. Like if you were 20,000 years ago, if you were hunting woolly mammoths, or if you're walking down the street and you get attacked, it's going to be good, that fear, because it's going to cause your adrenaline to go higher and so forth. But what happens is people get afraid of losing money. So as traders, we're supposed to get out of our losses and make sure that they're small. And we're supposed to let our winners run until they get to our price targets. But a lot of people have a hard time doing that. So let's say you have a paper trading system and it tells you, all right, buy 1,000 shares at 10, and if it gets to 15, sell it. Well, on paper, that's easy. All right, well, hey, it's at 10, it's at 11, it's at 12, it's at 13, it's at 14, it's at 15. I'm going to sell it. Wow, this is easy. I just made 50% on my money. But think about it in real life. When you get to the stock gets to 11, it's like, oh, that's $1,000. When it gets to 12, that's $2,000. Man, that's like real money. It gets
Right.
to 13, it's 3,000. So people get this they don't want to lose the profit. They have a fear of losing the money, so they end up selling their winners too soon. And on the opposite side, if people buy something and they have a small loss, what you should do is just blow it out and forget about it and move on to something else. But say someone buys a stock on paper at 10 and it goes to 9, and they say, all right, well, I'm going to get stopped out, no big deal. Well, in real life, that person, buys it at 10, it goes to 9. It's like, wow, I just lost $1,000. Am I dumb? So I'm going to hold on to this and hope that it comes back. And that's buyer's remorse, which I'm sure a lot of people listening to me right now have had before.
Right. And before we do get into the session here and all this stuff, big shout out there on the YouTube side. We got Fortnite God, Shinigami, what's going on? And we have, so here's the thing, Mark, um, the students definitely enjoy your company and, the way you teach them. For those that are not familiar, can you just give us a brief intro of your experience in Wall Street? And then we can go ahead and just kick it off here with some charts that you have ready for us.
Yeah, well, I have a pretty extensive experience with trading. I graduated business school back in the 90s, late 90s, so well, probably older than some of the people listening. But I was fortunate enough that I met a man named Mario Gabelli, and he's one of the greatest money managers probably in history, if you ask me. The guy's been successful for 40 years now, 30 years now, whatever. But anyway, I had he gave me a chance to work on his trading desk. So that was my first real trading job. So Mario, back then at least, I don't know if he still does, had a broker dealer, and I was made a market maker. So that was my first trading gig. And then after a while, after a couple of years, I left there and I went over to work for Steve Cohen, who now is pretty much most well known for owning the Mets, the New York Mets baseball team. But he was one of the greatest money managers in history. I mean, they have very different styles, but these guys are each great. So, it's almost like you get to take piano lessons from Mozart and Beethoven, to work with these two like legendary guys. But when I was at SAC, because I had a prominent role, I was offered a position to be a head of trading at this institutional money manager down in the city, which I did. And there I was the head trader. So I oversaw other people, and I oversaw various styles. I mean, we had hedge funds, mutual funds, long short stuff, currency trading, pretty much everything that you could almost think of when they were doing at that firm. I mean, there was no crypto because I don't think crypto existed yet. And then I was there for 5 years or 6 years. So they shut the East Coast office and asked me to move out to California. And it was literally like the day like my two daughters were born, my twin daughters were born. So I couldn't go, and I ended up finding a spot at a upstart hedge fund in Greenwich, where I was the head of trading there. And then, making a long story short, after 5 years there, I went over to another place where I was a head of trading. And about 5 years ago, the place I was at got taken over by this guy who was an idiot, and he blew the place up and destroyed it. And that's when I said to myself, I got to do something else, man. I got to leave this hedge fund industry because it's just not fun anymore. It used to be so much fun, like going out to dinner and going to games and everything. But now there's like the compliance is so strict. I mean, you could literally get fired if you send the wrong email to someone.
Right. And
but then that's when I decided to get into education. And after a few stops, I made my way over to here.
yeah, and as the chief educator of the Benzinga Trading School, man, definitely a lot of the students always, reach out just to say how much they love the classes and all that stuff, Mark. So if you don't mind, let's go ahead and just, let's pull up a quick chart here. Oh, by the way, before we do carry on or anything, because we do get this question, if you do want to join Mark's school, the Benzinga Trading School, we have the link posted in the chat. There's a 7-day trial for $7. And after that, it's $14.97 if you want to keep it for the year. And if you're committed pretty much to the community, to trading, the education, right? Now, really quick here. And you do get a laptop, right? After you sign up. Sorry, let's pull up a chart of Bitcoin, Mark. And let me just ask you something in general, right? Based on your experience, considering and I don't want to sound too bearish. On Bitcoin, I'm just what's happening out there. Considering all these things with Luna going to like close to zero, a lot of these places like Celsius that freezes your account, you lose all your money, or other companies. There are so many of these companies, and I was even reading on the news that some crypto fund owners pretty much filed for bankruptcy and disappeared. There's a lot of stuff happening, and suddenly everything makes sense now, Mark, where they were giving you a guaranteed 12%. Remember, all these places offering 12% guaranteed, right, annual, just for you to put your money in there. And it's so suspicious that now, they're all just like not giving money to anyone back, and they were pretty much collecting funds, guaranteeing a 12%. It just sounds like something weird's going on overall with crypto, and I guess it's a good learning experience. I mean, it went below 20,000. There's a lot of things happening that very similar in crypto. What is your opinion based on your experience in Wall Street? Do you just see this as another fad, considering everything that's happening there in the industry overall?
Well, I would say this: when someone guarantees you something, you should be a little bit skeptical, because there is no such thing as a guarantee. Look, I know we have our cryptocurrency enthusiasts and everything. Are they going to come back, in a meaningful way? I don't really know. I mean, if you look at it this way, how many cryptos have ceased to exist? Or, what was 10,000, 5,000, who even knows? But this is what happens when markets blow up. When markets are going higher, people have unrealistic expectations, and, they assume the markets are going to go higher forever. And unfortunately, in the real world, that's just not how it works. So let's see. Oh, I see Mendo has a question about Microsoft. Well, let me go over. Oh, well, I don't want to I'll go to Microsoft in a second. But when I look at a chart like this, let me digress a bit, because some of the people listening now or watching now probably remember this, and I just want to use this as an example. I'm not saying that this is this is what is going to happen with crypto. But if you've been following the markets for more than, say, 5 years, you probably remember the cannabis bubble. I mean, these, I think it was Tilray. That was the first cannabis company to go public. So that was in the summer of like 17. All right, look at this. So anyway, we got up to $150. It's trading at 131 now. So this just goes to show you when bubbles deflate, they can deflate for a long, long time. I mean, this is down more than 95%. We see it with some of the stocks that were big with the Reddit crowd last year. Look at this one, Ethereum. It went from $50 to it's at 250. And this is not unprecedented. I mean, in the NASDAQ bubble, there were a lot of stocks that traded to the hundreds and $200 a share that end up trading as penny stocks. The bottom line is this: the question is not why is the stock at 250? That's probably what it's worth. The question is, why did it ever get up to here in the first place? And this is because of what we're talking about today is in investment psychology. People are in their chat rooms, they get their stimmy checks, they're, like they're day trading. It's like, oh, it's going up. Oh, my friend bought it at 16. Now it's at 20. Oh, my other friend bought it at 20. Now it's at 22. Goes up and up and up. And finally, people are like, you know what? I'm sick of watching this thing. It's going higher every day. I'm just going to go in there and buy. And guess what? That's the type of action that happens at the very top of a market. So markets act different at the bottoms and at the tops, right? When you see a big move like this coming after a down move, that's generally a positive thing, and you get some follow through. When you see a big move after a long uptrend, that tells you that the market's getting tired. So because of emotions, people bought the stock up here, but there's no way the stock should ever have traded even close to up there. I mean, I don't know if you recall, but one of the more bizarre things I've seen on Wall Street, I could probably find it, but there was a period back here with AMC where in the quarterly report, the CEO literally said, don't buy our stock. It's overvalued. So when you have the CEO of the company come out and say, don't buy our stock, you got to pay attention because, people, generally CEOs are telling you to buy their stock, not to not buy it. So I remember this stuff, and unfortunately experience only comes with age. So I think that's where I can help people with like some practical application of how to make money in markets like this. But this stuff is not unprecedented. It's happened before. It's going to happen again, assuming, our civilization doesn't collapse over the next 20 years. So it's not unprecedented. Now, let me just show you all out there something, and then we'll take a look at Microsoft. All right. So we follow this very closely in the class. This is like the mothership, I guess, so to speak, the S&P 500 ETF, because this tracks the S&P 500, which is the most important, broadest benchmark. Now, it peaked out around 481 back in early January. Since 1929, there have been 25 bear markets in the United States. A bear market is defined as a market that goes down more than 20% from its peak. All right, so it's happened 25 times in the last, 90 years. The average decline has been 35%. So if this bear market that we're in now plays out just as average, SPY could get down from where it is now, 384, down to about 320. And that would be 35% off its peak. So we could still be having some ways to go here. We got our CPI number tomorrow, and we have the PPI on Thursday. If they come in really, really high, it's inflationary. The Fed's got to raise rates. It's going to push the market lower. But let me go take a look at Microsoft, because there's some unusual action going on in Microsoft today.
And Andy Turner on the YouTube side says, some say Bitcoin is still going to 100K this year, LOL, and says, Mark, what are your thoughts on the CPI tomorrow? And
Andy Turner, let me tell you something. Yeah. I would not be buying Bitcoin right now. So I think the CPI is probably going to come in above estimates. But then again, I don't know. With the way the commodities have been selling off and so forth, maybe not. But we'll look through that a little bit more.
Well,
All right.
this is the, I mean, the CPI that comes out now is the CPI from last month or last week.
Yeah. So, well, let's take. All right, let me just do Microsoft first, and then we'll look at this. All right, so I would say, Microsoft, there really is no news on the tape. This is probably, and I don't know this for sure, but it could be because of strength in the dollar. They came out a while ago, I don't know when it was, and they said that their earnings might be hurt by strength in the dollar, and the dollar has been really strong over the last few days. And the reason why that would be bad for a company like Microsoft is because if the company's based here, if they're selling their products abroad, like if you're in another country and you go to buy a Microsoft product and we have a strong dollar, you're going to have to pay higher prices. So that could be something to do here. Now, all that being said, from a technical point of view, I would see that we have found this short-term support right here, right? And we can see the support level. Now, we have 8 lessons in the class, right? And one of them, lesson number 2, is about how important it is to find these important price levels. In the institutional trading world that I was in, no one talks about crazy stuff like Elliott waves or harmonic charts or Gann theory. What we do talk about is it overbought? Is it oversold? What's the trend? What's the momentum? These are our classes. We have a class on levels. How to identify a particular level, that's important. We have a class on trends. We have a class on momentum, how to determine what momentum is. This is important because things that are oversold, that's a term of momentum. Every stock or security or market has like an average or typical trading range. If it gets beaten down really hard below that, we call that oversold. That's important because things that are oversold tend to reverse and go back into their range. On the opposite side, if something is above the range, we say that's overbought. And overbought stocks tend to reverse or to tend to revert. So I would say there's probably going to be a little bit of a bounce here in Microsoft, just because we found this short-term level. And it actually looks like it almost is even starting here. So my thoughts for tomorrow are the CPI is going to be bad. And how could you trade it? Well, for a longer term point of view, we had this from a longer term point of view, if we have a high inflation, this will go higher. And actually, a lot of our students did really well on this. We got into it back in here, because I've been talking about inflation for 2 years now. I don't know why these idiots at the Fed, these people at the Fed, maybe they don't look at charts. I don't know. I mean, this actually is kind of relevant. Let's go look at the copper future, right? Now, those of you who don't trade commodities, a lot of our students don't, but there are ETFs that track these commodities. So some of the most success we've seen in the class has come from natural gas ETFs. But anyway, I was writing about inflation at my prior place of employment back here in August. I wrote an article, I think it was August 12th. And the reason why I thought we were in this inflationary environment is because the price of copper was up so much. All right, so copper is a very important indicator. Now, what really kind of, I mean, you don't need to be a chart guru to look at this, right? A master chart guru. This looks pretty bad, man. And I think this is telling me that, we have this economic slowdown here. So this is, this is a full-blown crash, right? So let's see. So it's July. We're going to get to June CPI. I mean, a lot of these things, started really to come apart in June. So who knows? Maybe it'll be on the low side. But this is really troubling here. This tells me this is like economic, fire and brimstone type stuff. This could be a real indicator that the economy is really just starting to fall apart. We're looking at it on oil.
Right.
So
There's no indication that, I mean, this could last for many years, pretty much, Mark, right? Like, I mean, many new traders, they haven't seen a bear market maybe like you have, right? And maybe I mean, just being honest, right? This doesn't mean that just because CNBC says 2023 is the year of, like they were saying, the roaring 20s, whatever, when when they were saying on the COVID side, when we were getting the stimulus. So, I mean, it could go on for years, right? Doesn't have
yeah,
to.
yeah, it definitely could. And historically, it wouldn't be unprecedented. So we're going to look at. I can show you guys some cool charts of that. But I just wanted to, point out something here. So if we have signs of a slowdown, and this oil starts to really fall apart, what a bunch of the students are looking at is this ETF drip, which is designed to trade in the opposite direction of oil by 2 times. Or I'm sorry, one of the it's tracks an oil and gas index, not oil itself. But notice how it's up 5% today, whereas oil is whereas oil is down CO1. So it's really important to watch these commodities, even if you don't trade them. So oil is down 7. So that's a little bit of a dislocation there, which they'll probably fix at the rebalance at the end of the day. But let me show you guys something which you will find very interesting. I like to emphasize history in the class a lot, because I think if you understand history, you can get a much better grasp on the markets, because things, nothing repeats itself exactly, but it's like Mark Twain says, things rhyme, right? History doesn't repeat itself, but it rhymes. And why is that cut off there? All right, let me go to this one. Like, for example, economic policy. We could talk about energy policy now. Energy policy is causing all these problems around the world. Right? People are talking about, the war led to inflation. No, inflation led to the war. I mean, the war in Ukraine was driven by higher oil prices. If oil wasn't higher, Putin wouldn't have been able to afford to go in there. So, once again, they have it backwards. It's not that, now that the war, is happening, there's some inflation, but actually now look at how far prices are down. So that actually kind of contradicts this whole notion of that the war is causing all this inflation, because if we look at oil, if we look at oil, oil is back to where it was before the war started. So anyway, that's just something to keep in mind there. All right, so I'm going to bring up here a chart that's real long term, and it goes all the way back to the beginning of the Dow Jones, which goes back to the 1800s. And we have economic policy, right? There was in the 1890s, President Cleveland refused to go off of the gold standard, so that caused deflation. In the early 1800s, they had the Embargo Act, where they stopped buying stuff from all around the world, and that led to massive, economic turmoil. So if you see like history, you realize that this stuff, there's a lot of similarities, and the names change, the companies change, but the human nature hasn't changed. And that's what really charts are a study of, is human nature. Now, this chart, it does a good job of exposing this buy and hold myth that you've been hearing for the last 10 years. Yeah, buy and hold is great when the market's going up. But, myth number 1, buy and hold always works. Myth number 2, you can't outtime the market. You can outtime the market. I know people that have been doing it for years. You just got to know the right things to watch. And that's what we do in the class, is we look at those things. But anyway, look at this. This is the Dow Jones, right? It gets to 1,000 in 1965. It doesn't surpass it until 1982. So if you were buy and hold in this period, like buy and hold didn't work in this period. So there's been a lot of times in our country's history where we have bad markets that go on for a long time. Like this is 1937. Dow's at 173. May 1942, it's at 97. These are the things I lived through. This is right when I got to Wall Street. It was like pretty much right about here. I would say like right in here. We had this market here. We peaked in February of, I think it was actually March of 2000. didn't find a bottom until August of '02. So that was over 2 years. That was 2.5 years. Then the housing crisis, this is August of '07. This is January of '09, right? So year and a half. And we didn't surpass this peak until 2012. So if you look at this, what we've been seeing in this bear market is it's like hardly a blip on the radar screen. It doesn't even really kind of show up. So anyway, I think we can go down. And going back to your question about, how you could play an economic slowdown would be, once the oil starts going lower, we would look at some of these inverse ETFs.
Right. And so we have Vape King on the YouTube side saying, I'm thinking 2 to 3 years. Hopefully I'm wrong. And Andy Turner, were they tracking the market with charts in the late 1800s? That's amazing. Well, Andy, look, I mean, this is really what Mark does. Throughout the day when he's in the trading school, he does have this approach where it actually kinds of pieces it together with history, right? But it's pretty interesting. This is going on throughout the whole day. Mark, maybe you can explain a little bit about the trading school. What do you do in the trading school? What are the schedules and all that stuff for the folks here?
Okay, cool. Yeah, Andy, we look at a lot of history. I'll show you some of our newsletters in a while. And Vape King, I think he'll probably fit right in. Won't be the only person vaping in our class. All right, so anyway, when I decided to do this class, I just thought, what are the important principles of the stock market? And the principles will never change. The stocks will change, the companies will change, the people will change, but the principles won't change. And the classes are based on these principles. So one principle is that there are certain price levels that are more important than others. So we'd probably spend about the first half an hour of the class, and the classes go from 7 in the morning to 9 in the morning Eastern time. And then we have a noon class that goes from noon to 1. But we talk about what are principles of the market, right? As long as there are financial markets, there's going to be certain price levels that are more important than others. It's just the way it works. Sometimes we know why a level is important, and sometimes we don't. But we study the principles, and then we go to apply them to the market in real time. So you can actually, have some practicality. Like you can look at a book, right? You can read a book, and everyone is, a genius in hindsight. I could write a book and be like, oh, here's a great call I made. Here's a great call I made. Blah, blah, blah. Everyone's a genius in hindsight. But by looking at the market in real time, I think that's what kind of makes us different from other trading schools or whatever. Now just look at this, right? You don't need to be a market guru to know that certain price levels are more important than others. You could see it. Well, I mean, let me rephrase that. You don't need to be a market guru to see that some price levels are more important than others. Now, we talked about psychology before, right? One of the things that we have in bear markets is buyer's remorse. People buy stocks and they go lower, and then they regret buying them. So we can see this principle in a chart. So this is not astrology. This is not tea leaves. This is a study of the supply and demand dynamics that are going on within this stock here. So this is a support level. Support levels, there's a lot of buyers. Markets stop going down when they get to support levels, right? And they tend to bounce off of them. But what happens here when the price actually goes below where the people bought at support? A lot of the people that are still holding it start to experience buyer's remorse. And they tell themselves, you know what, I made a mistake. I shouldn't have bought this. I'm going to sell it, but I'm only going to sell it if I can get it for the same price that I bought it at. That way I can exit the trade at break even. So what do? Well, that leads them to place their sell orders at the same level they bought at. And if there's enough of these sell orders, the level that was support converts into resistance. So if you have a situation like, just say you bought XLK down here and it's going higher and you're wondering, where should I sell it? What should my target price be? Well, look into the past, which is, what this is. If you were here, this is the past, and look for the levels that were important. And you would have seen, hey, 163 was resistance here and here. It was support here and here. There's a good chance, not a guarantee, but there's a good chance that when XLK gets to 163, it hits resistance again. And sure enough, it did. So this isn't magic, it's not like some super secret system that I studied, stumbled across on some vision quest or whatever. It's just understanding that some price levels are more important than others. And when you know where these levels are, it's like your map to the market. You get to get the sense of when things are going to turn or when it's important to pay attention.
Okay. Yeah. Right. Right.
Go ahead.
And what's the schedule that you have right now for all the people here? Well, I mean, in general for the class.
Well, we do 8 classes. And then when we get to the end of the 8th class, we start again. So the classes go Monday through Thursday. The Friday classes are a review. But today was our investment psychology class. But we talk like the levels class, we talk about the price levels. Then we have the trends class. We just talk about how to identify a trend, how to identify a trend change. We have a class on chart patterns. We have a class that tomorrow is how to look at the macro part of the market and understand how all the different sectors are interrelated and they all kind of work together.
Right. And what are the times of
the trading models and strategies?
And what times do you do this? Because I know that you have 2 times during the day, right?
Yeah, Monday through Friday, 7 to 9, and Monday through Thursday, noon to 1. And if there's important stuff going on, it'll go longer. But yeah, so we look at these from those basic principles. We can convert that knowledge into how to make money, right? Like let me show you a trade where a lot of the students did really, really well. Some of them even said it was like the best trade that they've ever had. Or a couple of the students said it was the best trade they've ever had. And in a lot of ways, markets that are going down are easier to make money in than markets that are going up, because markets go down a lot faster than they go up. That's because selling is driven by fear and buying is driven by hope, right? So fear is a much more powerful emotion. Now, this is where these students like keyed in on this. And Rodrigo, I know you've been asking me for a list of trades, so I'm gonna write this one up for you. So notice here, we have an example of resistance becoming support. Now, this is the opposite. We just looked at buyer's remorse. That causes support levels to convert into resistance. Seller's remorse causes the opposite effect. It causes resistance to turn into support. So anyway, we come down here, we rally, we get some resistance up here, all right? Once we go higher, a lot of the people who sold tell themselves, hey man, I shouldn't have sold. I'm going to buy this stock back, but I'm only going to buy it back if I can get it for the same price I sold at. So as a result, they place their buy order at the same level that they sold at. All right. Now, this is where a lot of these students really did well. When we saw this move here, taking out this support, a lot of times when support levels break, we get decent moves lower or big moves lower, like we had here, right? So now forget about, shorting the stock or options. There is an ETF that is designed to trade inversely to this, and it's SQQQ. And it's actually designed to move, I think, 3 times in the direction, right? So when Q's was breaking that support, this is where people would have been buying it, right? This is this is like the inverse. Just picture this upside down in a mirror image, or just picture this upside down and you would see. But anyway, so think about this. Once it became clear that support was breaking, people jumped in here, bought this around 50. 2 days later, it was at 63. And a bunch of the students that are options traders bought options on this. So one of the things in the class that we talk about is how to get exposure to these things that are going on. A lot of people don't even know that there are these inverse ETFs. And even a lot of professional people, like, you guys have probably seen it if you watch the financial media over the last few months. People are saying like, oh, you should go to cash, you should go to cash, you should go to cash. Well, if you think the market's going to go down, it doesn't make sense to go to cash. It makes sense to put your money into something that's going to go up if the market goes down. For example, this is designed to trade inversely to the S&P 500. SH is the symbol. It trades. It's just a ETF. It trades just like a regular stock. It's nothing crazy, leveraged, inverse. But say you have a bunch of stocks that you have gains on, and you don't want to sell them because you don't want to take the gains. You want to maybe put it off till you get past tax season or whatever. Well, you could park something in like this in your account as a hedge. If your stocks go down, this will go up. So a perfect hedge, you won't lose any money. So I don't know. I don't understand why even some people that are professionals don't even know that stuff like this exists. But there's a lot of doesn't take much to be considered a guru these days. All right. So when we talk about momentum, that's another one of our classes. We care about momentum because when things get overstretched from one side to the other, let's go back to Microsoft, I guess. The markets could be like a rubber band, right? If something gets overstretched, there's a tendency for it to reverse. And let me bring you these. Let me show you guys Bollinger Bands, because these things are really effective and they're really easy and they're on most software, or every software that I've ever seen. This is a way that traders measure momentum, is with these bands, right? So the top red line here, or band, is 2 standard deviations above the 20-day moving average, and the bottom line is 2 standard deviations below. So why do we care about that? Well, we care about it because if it exceeds this threshold, it's going to get the attention of all these algorithmic trading programs that are based on statistics, because standard deviation is a statistical concept. So the idea is when you get outside of the band, you expect to sell off, and when you get below it, you expect a move higher. So this is one way we can look at momentum. There's a whole slew of different ways, but when a stock is oversold, meaning it's below this red line and it gets to a support level, there's a really good chance it's going to bounce, right? Oversold stocks that get to rebound tend to bounce. So, that's a basic principle of the markets. Let's find, I don't know, let's just pick a random stock. Let's pick US Steel. Yeah, all right, so we can see right here, well, I guess this isn't that good of an example. I don't know. What's the stock I haven't looked at in a while? AT&T. I'm just trying to find something that would be a good example of an oversold stock that gets to support. But anyway, even here, right? We get oversold, we rally, we get overbought, we sell off, we rally here. Let's go look at Bitcoin, actually. We're going to look at the cryptos.
Hey, Mark, really quick, want to give a big shout out here to TRZ. TRZ, welcome to the trading school. Let's go.
Thank you, TRZ. All right, so now Bitcoin here, we can see some trading lessons, so to speak, right? We look what happened when we got up to these peaks here, right? We got overbought, we got extended above the Bollinger Band, and that was at the top. Same thing over here. This would have been a sell signal if you were trading with this kind of a model. Here, that would have been a sell signal there. So look how good it's worked for sell signals on Bitcoin. The buy signals haven't been as good. Oh, that was a good one. That's a good one. All right, so let's take a look at this, and I can just show you all some things about basic chart principles and so forth. And we can see here, right? This is the concept of market memory. You might have heard that term, market memory. That means that if a price level is important, it could be important for a long time. All right. That's what we refer to as market memory. You've probably heard that term. Now look at this here for Bitcoin, right? Back here in January of 21, when we sold off, we found support there. All right. So now just pretend Bitcoin is up here. and we see that it's overbought with our Bollinger Bands. All right. So you say to yourself, you know what? My friend just bought Bitcoin. I've been thinking about buying it. You know, I don't know if I should or not. Let me take a look at the chart here. Let's go see. And in the class, we learn how to think for ourselves. We don't want to have to rely on other people. It's a school, right? So wait a second, it's overbought. I'm not going to buy it. I'm going to wait for it to be oversold when I buy it. Oh, you know, hey, look at this. We're going down, we're going down. Oh, wow, look at this. We're oversold and we've reached a support level. Oversold things that reach the support tend to bounce. And that's certainly, you know, that's what happened here. So it's important to watch these price levels because they can stay important for longer than you think they can. Lockheed Martin, all right, this is a good example here. All right, so here we have a chart of 2 years, and we can see that we've had clear resistance around the 395 level. And you can see here that when we got up here, we got overbought. All right, so I'm going to take these Bollinger Bands off. Actually, I'm going to put them back on. We see 395 has been important for 2 years, right? We're going into the sell-off. Going into the sell-off, we get oversold and we reach a level that was support. So it's not a coincidence, some random act of the market gods that we bounced here. The reason why we found a bottom here is because it was support over here. We have remorseful sellers saying they're going to buy the stock back. And sure enough, within a point or two, look at that, within a point or two, we got that bounce. So if you don't know where these levels are, Andy asks, for Bollinger Bands, you use the standard 2 deviations. Yeah, generally I just stick to the defaults. But all of these, most of these indicators and oscillators, they come with default settings. So, we can change these to make them more appropriate for a particular security.
Right. And now someone's here asking about the investment psychology class. What can you speak about that particular section in the curriculum?
Let's put it this way. If you're driving down the highway and you come to a toll booth and you see all these cars going into one lane, you're going to see most people jump onto that line, right? Even though there's 50 cars ahead of them. But then if you look around around the traffic and up at one of maybe the other lanes, you see the light's green. And you say to yourself, well, why isn't anyone going there? The light's green. And you say to yourself, well, wait a second. I'm going to go. I'm going to drive through that green. And you go by all the cars and you go through and then you look in your mirror and you see other people following you. So as long as that keeps happening, that's human nature of your herd instinct. You want to do what other people are doing. As long as that keeps happening, and it will because it's human nature, then people like us can make money in the market by being on the other side of that. That's why we talk about buy when there's blood in the streets, buy when everybody's panicking. Well, what happens in a panic or like a crash, people just get afraid, right? It's a herd instinct. Other people are selling. There's safety in numbers, right? There's safety in numbers. Now, look at it this way. Say you're walking down in a building somewhere and all of a sudden a bunch of people come running out of a room and they have this terrified look on their face. Your natural instinct is going to be, oh man, I should run away. That's just the herd instinct. But if we're aware of our emotions and we're aware of our psychology, that is really, a big step into becoming successful. Because if your model is telling you to buy and everyone else is panicking, then that's a psychology thing. You're separating yourself from the crowd. It's think about fashion. Why do you like a particular shirt, or why are ties in fashion? Look at fashion from, if you look at from the 70s, they had the really big ties and it kind of looks silly to us, but that shows people's instinct to be part of the herd. And if you can be not part of the herd, and if you could think on the other side, you start selling stuff when people are euphorically driving things up to prices they shouldn't be at, or you start buying when people are panicking and they start selling things at way lower than they should. So the investment psychology is I guess you can't really say enough about how important it is. Like, let's just look at this particular company here, right? International paper. And I just brought it up just randomly. Now, it's up 2% today. This is a company that has a market capitalization of $15 billion, and it's up 2%. So it's added $200 million to its valuation. So what happened since this morning that made this company 2% more valuable? And the answer is probably nothing, other than investor perceptions had changed. 2 days ago, it was at 43 and people were selling it. What has caused the valuation of this company to change so much? And the answer is nothing. It's just people's perceptions. And now let's look at this. All right. So this is a perfect example of what we were just talking about. Oversold stocks that get to support tend to bounce. This is another way of measuring momentum down here, this RSI indicator. This just measures how far something has moved in a given period of time. It's not the same as volatility. Volatility is like how much something moves, how volatile it is, right? Momentum is how far has it moved from point A to point B. And that's what one of the ways of measuring it is down here. So what do we have here? We have a support level, right? Market's going lower, it's going lower, people are panicking, it's selling off, gets oversold, reaches support, and what happens? It bounces, right? So isn't that easy? Yeah, that's the thing, man. It doesn't need to be complicated. I see all these people that have these like crazy systems, and they have all these different things on their charts, and it doesn't need to be complicated. If we just focus on levels, trends, momentum, and psychology, that's what leads to success. And if we talk about in our patterns class, the head and shoulders pattern or the ascending triangle pattern, there's validity to that stuff. But a lot of people, and I can understand why a lot of people are confused and might think it's more difficult than it is. And that's because a lot of people out there don't really seem to know what they're doing. Certainly in the retail world, but even in the institutional world, and even some of these like so-called gurus, some of these gurus you see like on TV, people who you would recognize, they don't seem to know what they're really talking about either. I mean, there are a few people out there that get it, but most people don't. So we're just looking at this in terms of supply and demand, and we could see here, look, we got a clear resistance level, gets overbought, gets to resistance, and what happens? It goes from 49 to 46 over the next few days. So trends, levels, momentum, that's really the key to it. If you know where these price levels are, then it's like a map. If not being able to read a chart, if you're a trader, it's like you're going to a town where you haven't been before, and you don't have a GPS and you don't have a map, but somehow you think you're going to be able to get your way around the town, and it's just it's not going to happen. So like, say you like international paper, say you think, oh man, this is a really good company, I think I'm going to buy it. Well, wait a second, it's at a resistance level. I'm probably going to wait to see if it breaks this resistance or not, because a lot of times when things don't get to resistance, they don't get through resistance, they sell off. Oh, it's going lower. Now it's getting really attractive. Where should I buy it? Well, gee, back in March, it found a bottom around 41. So maybe I'll buy it when it gets to 41. And guess what? Not only is it found support, it's oversold, and oversold things that get to support tend to bounce. So just by keying in on these levels, it's like, that's where the real secret to making the money is the levels, knowing the trends, knowing the momentum, and understanding risk psychology. And it's keep it simple, it's logic, common sense, experience, and no hedge fund trader is out there talking about your harmonic charts, like some of this stuff here, right? like the Gann box, Fibonacci circles. I mean, if you can make money off this stuff, great. But I mean, I don't know. I don't think it needs to be this complicated. But people like this stuff for some reason. People really like these, or they're called harmonic charts. I mean, I don't even know what the hell this is. Like, if you could make money off of this, you're probably so smart that you could probably like predict what the lottery numbers are going to be tomorrow. So you don't even need to worry about trading. But I don't really, oh, look, we can make it look like a butterfly, right? Your little butterfly spread here. But anyway,
and I guess, Mark, that so a lot of people that are new into trading, they might just fall they might fall into this trap of being confident because they have an indicator, or they put all their all their weight on an indicator, or they put too many indicators, and they forget about the most important part, which is reading the chart itself.
yeah, it's understanding what you're seeing on the chart. Understanding that if you see a pattern, and it's valid, there's a logical reason for it. It's not like this stuff that we just looked at here. Like, I don't know what that is, right? But it's understanding why a particular level is support, why a particular level is resistance, and then the momentum. Yeah, so it's just logic, and there's a lot of confusion out there, and it's pretty understandable because we have everything from people that are trying hard but they just don't have the experience, to people that are just like downright frauds and that just lie. And we've seen some of our other trading school competitors have to pay substantial fines recently to the FTC. But it doesn't need to be complicated. And I think that maybe Wall Street wants to make stuff seem complicated so they can charge you fees for reports. There's people that have only traded in the bear or bull market, so they didn't even really know what to expect or what this is going to, what this down market's going to be like. And I'll tell you guys something that happened, and this is where we started to get negative on the market, right? And where we started to get bearish, and it was like back in November and December, right? So this is our technology sector, and this peaked right here, right, in December. And let's look at our S&P 500. All right, so the S&P 500 peaked, I think, in early January. Yeah, so January 4th, right? But this is what's going on here. You have a couple stocks that have significant weightings. All right, so that have significant weightings in the benchmark. So I'm going to go over here, and this is the S&P 500. So just pretend this is the S&P 500 because it tracks it almost perfectly. Actually, we don't want to look at that. We want to look at the holdings. So now look at this, right? Apple this is an index of 500 stocks. Apple is 6.8% of it. Microsoft is 6%. Amazon is 3%. Google is just over 4%. So, so that's 12. So that's 20%. Then we got some other big names, but this is an index of 500 companies. So I would imagine the smallest company is probably has a weighting that's not even 1%. So what happened back here is the market really started to come apart back in here in November. And when you look at the market every day, you just see it. I mean, by here, a lot of the Reddit stocks had crashed. So a lot of stocks were going lower, and the money was going into the safety stocks, the stocks like Apple and Microsoft. So this really masked the weakness that was going on, the underlying weakness in the market internals, I guess we could say. People are just pumping money into the good stocks, right? I'm going to sell these 5 stocks I don't like, and I'm going to go buy Apple, or I'm going to go buy Microsoft, right? Now, this is one of the things we look at here. In this particular ETF, every stock has the same weighting. So no one stock can really dominate this more than another. And look at this. We broke our uptrend back in November. So this is where we really started to think, oh, gee, things are really starting to look pretty weak here. Inflation is going on, the market's kind of internals are kind of breaking down. But another lesson to be learned is that the market doesn't all go down at the same time. It's not like the market crashes and every single stock goes down. We notice our technology stocks peak back here in December, or at least this benchmark, this part of the market. This ETF tracks the technology stocks. We have this ETF that tracks the consumer staple stocks. This didn't peak until April, right? So, we could sell your tech stocks and go into other things. People get too focused on the FANG stocks and so forth. And, people are talking now about like, oh, their portfolios are down. Look at General Mills. General Mills is trading at an all-time high. And the reason why this is trading at all-time highs is because the prices of wheat are collapsing, which makes General Mills more profitable. So it's almost like a kind of a reverse play, right? And this is one of the things we talked about in class today here, and I should probably write this one up too. If wheat breaks this support level, General Mills is probably going to keep going higher. So, even if you don't play commodities stocks or in the commodities markets, commodities can move the price of stocks.
Right. Right. So, Mark, we've been here for quite some time here with the students and with some people here on the YouTube side as well. We have about, I'd say maybe 5 more minutes here. So maybe just give us some closing remarks on your end on just the markets and really what's happening in the school, why the folks here should consider joining our community here at Benzinga Trading School.
Well, the short answer is that you are going to, hopefully, or at least I'm going to try, but you're going to learn how the markets really work and how to apply it practically, right? This isn't like, all right, I'm going to read a book on Saturday and then on Monday I'm going to try to use something I learned and see what happens. We look at the market every day and we look at every various parts, commodities, and we go into the mindset of it the mindset of let's let the market tell us what to do, right? You don't want to have a preconceived notion. You want to go in, and if you see something that looks compelling, then that's what you pay attention to. Like, for example, right now wheat is testing support. If it breaks down, there's a chance General Mills is going to go higher. So this would be letting the market tell us what to do. This isn't guessing. Oh, I'm going to buy General Mills. I think it's going to go higher. Because guess what? If this rebounds, then General Mills is probably going to go a little bit lower, right? So the less wheat costs, the more profitable General Mills becomes. So as opposed to going into the market with a preconceived notion, I'm going to do this, I'm going to do that, we let the market tell us what to do. And one of the books that is on our Benzinga Trading School recommended list is a book called Remnants of a Stock Operator, which was written in the early 1920s. And it's supposedly about a guy who was a famous trader back then, Jesse Livermore. And one of the things he says that really strikes me is that, I haven't made money by being in the market. I've made money by being out of the market. And what he was referring to was the concept of let the market tell you what to do. All right. Wait for the market to give you ideas. If you can't, it's okay to take a day off if you don't see anything that really sticks out at you. I mean, as we're going here to the summer into August, there might be some really slow days. But if we let the market tell us what to do, and the market tells us what to do by telling us how it acts when it gets to levels of importance, then that's where we get our trading ideas from. So we don't guess, we let the market tell us what to do. It's common sense, it's logic, and it's practical. It's not esoteric. So let the market tell us what to do. We focus on our psychology, and people have done quite well since we started.
All right there. Mark Putrino former hedge fund manager and chief educator at the Benzinga Trading School. Thanks a lot for being here, my friend.
All right, Rodrigo.
I'll
I'll
see you
talk
in
to
the
you soon.
school. Yep. What
Okay.
class you have tomorrow? Do you know?
Tomorrow is a class about how we look at the different sectors to see what's going to go on with the broader market. The S&P 500 consists of 11 sectors: technology, healthcare, finance, and so on. And by understanding what's going on within the sectors, we get a better idea of what's going to probably happen in the broader market. So that's what tomorrow's class is. And then the Thursday class is about how to build trading models and investment strategies.
All right, man.
All right.
Looking
So
forward
I thank
to it.
everybody. Rodrigo's going to hang out if there's any questions. Thanks, Rodrigo. I will see you in the school.
All right, brother. Thanks a lot, man. Mark
Okay.
Putrino. There you go. And I'm going to show you guys really quick what the school is all about. So it's going to be like maybe 5 minutes or something like that. If you do have a question, post it. I'll try to answer it while I'm here. But really quick for all you guys that joined, once you get into the school, you're going to see on the header, everything that you need is there, right? Your dashboard. This is pretty much going to give you a full schedule set of what's coming up on Wednesday, Thursday, Friday, like next Monday, Tuesday, right? So we have another, well, this was the class from today, but tomorrow you see that you have market principles, analysis, and sentiment. This is 7 a.m. Eastern, my time, Eastern. And then you have the second class of the day, which is from 12 to 1. The first one is 7 to 9 a.m. Eastern. The second class is the Q&A session, the same chapter, right, from 12 to 1 p.m. So that's basically going to be like your review, catch up. Hey, what are you looking at? Questions on the lessons. And this is every day, right? You can always check the schedule. Now, whenever the class is live, this is where you have to go. In the header, again, everything in the header. You click on live. Whenever the session is live, you're going to see Mark there. This is a chart, live chart. You can hide it. You can also, you have a live chat here that is basically for the, you have a separate chart there that you can basically use there for, for live back and forth with the instructor, so that basically as Mark is progressing through the lesson, you can actually ask your question and all that stuff. It's really good. It's a nice community there. So cool. All right. Next thing, the other stuff I want to show you are the live trading rooms. They're open the whole day, like 24/7. You have one, the student project plan. This is where they have like a trading model there. The students working together, again, teamwork, right? Student chart of the day, where people, students are posting what they're learning, things like that, trade ideas, all those kind of things. If you cannot attend the live Q&A sessions, we have a chat room called Questions for Mark, literally so that you can just pop in there and ask Mark any question. Master of the obvious, I believe Mark is using this as it's some sort of market insights through history, you could say. Then you have Mark's trade ideas, where he's posting levels, setups, all that sort of stuff. And he's also posting the weekly preview, which I already have pulled up here. So goes over tickers, goes over setups, levels, and really overall market schematics, right, of what's happening there. All right, really important, really important. He goes over that live. Let's see, you have a bunch of other rooms here: class materials, class files. We have some quizzes here. So if you do want to quiz yourself on where you are, find out your strengths and weaknesses and work on those accordingly, because everybody's different. You do have these live quizzes here that you can take. And if you have questions on that, guess what? You have a chat room called Questions for Mark that you can always go back and ask questions there. So those were the live trading rooms. Next thing you need to know about is Pro. This is included with your trading school. I don't know if there's any particular stock that you guys want me to look at, anything that's ripping or whatnot, but with Pro, you can pretty much find everything about the stock, all the news that is happening regarding around it. Pretty much Benzinga, it's like financial data, financial media kind of company. And then with the platform we have in Benzinga Pro, it just comes out really well together, because we're able to pretty much give you the best of both worlds, right? Not just trading perspective, but also the news overall. And many times when I was using, before I used Pro, before I got it with Pro, I was using another brokerage as an example, and you'd be surprised. I see stocks going up 50%, 100%, 40%. There's no news in the brokerage news feed. So then I would have to go, and then I went in to look in my pro, and there were several pieces of news and articles and content, not just from that same day, but from before, from a day, 2, 3 before, even a week before. So that's really the beauty of pro, that it can actually help you consolidate those trade ideas. And things from everything from the trade concept, from the trade and from the inception of the trade, right? The thought of the trade, from that moment all the way to the execution and to closing that trade. Benzinga Pro is basically your #1 must-have partner, because it can help you throughout the whole process of the trade. Everything from finding the right trade to consolidating that trade idea, not just with chartings, technicals that you have in here, but with peer analysis, checking over their financials there, doing the technical analysis on the charts, because these are live second-to-second charts. That's really how you execute trades from beginning to end. Pro is basically like your tool for that. You have a bunch of scanners as well. You can trade this thing. You can, go long on it, short on it. It doesn't matter. You can pretty much even select the time frame that you want this scanner to pretty much start aggregating the data for you. You can select the market cap, the price for it, basically everything that you need when it comes to having a scanner. You can find it here. We also added the option that you can filter out the sectors. So if you only want to trade energy, you can only select energy, consumer staples, financials, healthcare, industrials. You can select them all. You can unselect them all and just have it run on its own, right? Covering all the sectors. But if you do want to find a specific longer term setup, maybe for a swing or for a longer term investment, you could say, you could start looking at longer trends, 1, 3, 4 months, 6 months, 1 year, 1 year to date, custom. So it can really help you find out stocks that are performing within any specific sector that you want. So to me, it's a great tool, not just for day trading, scalping, whatever it is that you're doing, swinging, doing spreads, or just buying and holding for the long term. You can find high quality names for whatever you're trying to do, right? It could be high quality for scalping, but it could be low quality for investment, maybe, right? So the best of both worlds, really, for what you're trying to do as a trader. Keep in mind, these are tools designed by traders for traders. We have a bunch of developers here that are basically working throughout, day in and out, on improving the platforms, on adding more features. These are features that you guys have requested, that we've pretty much brought to life, and we continue to improve and work on them. Even this thing where you can like slide, the stuff left to right. Like those are little things, none of this comes like pre-packaged. We have to code it. We have to build it. This is our code and stuff. So it takes time. But yeah, that's really goes the same for the trading school. These live trading rooms that you have here, these are all Benzinga technology that we've built here. These recordings, if you miss any of the classes, you can find them all there. The investment psychology one, momentum, trends, levels, everything, you can find it there. And you can watch it in case you cannot attend live. So folks, I think this kind of covers most of the stuff for the school. If you do have any questions, I'm going to leave the email. If you do want to reach out or call, it's fine. And thanks a lot for watching. We'll see you guys in the class tomorrow. And trade safe, trade responsibly. Any questions, reach out, and have a great day, folks.